Sure, I think that there are arguments to be made for how international trade and investment have been a contributing factor to the financial crisis and global slowdown that we're now experiencing. Economists had been very concerned starting in the early 2000s that global imbalances, excessive savings in some countries, large developing countries like China and Germany and Japan, were causing investors to spread their savings around the world, which they were buying assets in the United States, which was creating low interest rates in the United States and the opportunity for U.S. consumers to import a lot of goods and services from around the world. These imbalances at a low level are probably sustainable for some time. But by the mid-2000s, they were growing quite large, and people were concerned that they were unsustainable, and that could lead to a precipitous drop in confidence in the dollar, confidence in the U.S., and lead to kind of a hard landing scenario where we'd have a global recession. Then it looked like in 2000, as the U.S. economy started to cool, in part because of Fed action, that we would have a nice rebalancing. U.S. exports started to grow, U.S. imports started to slow, the current account deficit began to shrink, and it looked like we might have an orderly rebalancing of the world economy. But then, and it's hard to disentangle the financial crisis from these global capital flows and what contributed to what. But then when we had the fallout of the subprime lending and the lockup in financial markets that originated in the United States, then we had a different kind of hard landing scenario where global trade and commerce just kind of froze up. And now we have what looks to be a very stiff, steep global recession. So it's hard to see how trade is going to pull the U.S. out of it. In 2000 and early 2008, it looked like trade was contributing positively to U.S. GDP growth, and that was going to be the nice rebalancing story. But now it's hard to see where there's evidence of trade contributing positively to U.S. growth. In fact, is we need to borrow more to finance the government's fiscal stimulus package. We'll probably see the current account deficit grow again. Well, I think that what we've seen in international trade is it's hard to say as a result of, but kind of concomitant with the global financial crisis, is a sharp contraction in trade. The major exporting countries' exports are off significantly. Global trade is forecast to shrink about 9% in 2009. This is the first time since the early 1980s that global trade has shrank. So this is a big change. Over the last 15 years, global trade had been growing on an average basis annually about 6% a year. So to shrink 9% is a big abrupt change. What's going to happen in the future is very hard to predict, but I think as economies, as these fiscal stimulus packages that have been announced by governments around the world, as those start to kick in, and hopefully as the financial system in the United States and in other countries are returned to more normal levels of operation, we'll start to see the economy revive, and that will lead to increased international trade. While it's hard to see how exports are going to pull the United States out of this recession, I think that continued openness to international commerce, both in terms of goods trade and services trade and international capital flows, is crucial to the United States. I think that openness to trade and openness to international capital flows have enabled the United States to build one of the most dynamic economies in the world. And to shut that down would be a grave mistake. I think that allowing firms to import intermediate inputs from the most productive producers, be they here in the United States or elsewhere around the world is what makes our companies the most efficient. So we want that to continue. We want that free flow of ideas, free flow of goods, free flow of capital to continue to have a dynamic economy. I think that there is trouble brewing, in part because of the recession. I think that there is a tendency among governments, when people are hurting, to try to take policy actions to mitigate the pain. That's understandable and in some ways admirable, yet we need to be careful about what policies we choose to mitigate the pain. And I think that right now there are signs of creeping protectionism that run the risk of derailing this highly efficient system of global commerce that's developed in the world over the last 10 years. So I think that creeping protectionism is an issue, and it's hard to tell how big an issue right now, but I think there are signs for concern. When the G20, the group of the biggest 20 economies in the world met last year, the leaders pledged that they would all keep open access to their markets. The World Bank now has reported that of those 20, 17 have already taken protectionist measures to prohibit imports or somehow throw sand in the gears of global trade. So I think that that's a disturbing sign. I think things that have happened here in the United States are also disturbing. The Buy America provisions that were tucked away into the stimulus package are of concern. Turning back the Mexican truck program is also disturbing, and another sign of this kind of creeping protectionism to try to withhold efficient foreign producers from the U.S. market to appease domestic constituencies. It's understandable when people are hurting that we want to help them, and people are certainly hurting now, but we want to do it in a way that doesn't distort the economy. If we put these trade prohibitions in place now, at some point, hopefully soon when the economy recovers, we'll want to go back to a more efficient method of production. And trade barriers are going to distort that. They're going to distort decisions now about how people allocate effort, allocate capital, how they make business decisions. And then once the recession is hopefully a distant memory, we'll need to make decisions about how to get rid of those protections. And once in place, they're very difficult to take away. So we don't want to inhibit free trade now. We want the most efficient provision of goods and services to persist even during this downturn. And we certainly don't want to impede efficient provision as we go forward and come out of this recession. I think when people think about protection, it's useful to think back to the Great Depression, when, again, a time of much greater dislocation in economies around the world, and governments fell prey to this temptation to use protectionism to protect jobs. And the strong sense among economists is that this really deepened the recession. You can think of now, with much more globally integrated supply chains, tariffs or other barriers to the free flow of commerce will disrupt these finely tuned production processes that companies have set up around the world. When we used to think about just trading final goods, then there was only really one point where governments could intervene. Between the exporter and the importer, there was a point for the government to impose a tariff. But now, if goods are one component is made in the United States, it's shipped to Canada for further processing, then it goes to Mexico, and then back to the United States. Well, and then the final car is shipped to some other destination somewhere in South America. There are now 4 or 5 points for governments to intervene and mess up that very efficient production process. You know, I think back, I grew up in Detroit, and as a kid visited the River Rouge plant, which was this huge vertically integrated car plant in southeastern Michigan. And they would talk about how sand and rubber and iron ore would go in one end and cars would come out the other. You know, just, you know, incredibly vertically integrated. And there's nothing like that anymore. You know, the parts and components come from all over the world. And we don't want to disrupt that flow.